Have you ever wondered why the crypto market seems to behave irrationally? Or why your trades don't always go as planned? It's not just about numbers, charts, and financial indicators. It's about something much deeper. Welcome to the fascinating world of trading psychology. Trading psychology is the study of how our emotions and mental state can significantly affect our trading decisions. It's the invisible force that often drives the market in unpredictable ways. When traders let fear, greed, or hope dictate their decisions, the consequences can be costly. But here's the good news. By understanding and mastering trading psychology, you can turn these emotional pitfalls into your advantage. You'll start to see the market through a different lens, one that reveals the herd mentality, the fear of missing out, and the greed of other traders. Understanding trading psychology is the first step towards becoming a successful trader. So, let's dive in and unravel the mysteries of the human mind in the world of trading. When you're trading, do you follow your gut or do you stick to your plan? This question is at the heart of decision-making in trading. You see, trading is a fascinating blend of strategy, analysis, and yes, psychology. Let's look at a common scenario. Imagine you've made a trade based on thorough analysis. The market, however, starts to move against you. Panic sets in. Your instincts scream at you to cut your losses and sell. But your strategy, the one you painstakingly crafted, advises you to hold on. This internal struggle is a classic example of the psychological complexities involved in trading decisions. At the core of this struggle are cognitive biases, inherent errors in our thinking that affect our decisions. These biases are like invisible puppeteers, pulling our strings and influencing our trading choices, often to our detriment. One such puppeteer is the confirmation bias, where we pay more attention to information that aligns with our beliefs and ignore information that contradicts them. In the trading world, this could mean overlooking critical market signals that go against our current trade. Another puppeteer is the loss aversion bias. We are so wired to avoid losses that we often make hasty, irrational decisions when facing a potential loss. Think back to the panic-stricken trader we talked about earlier. That's loss aversion in action. These biases, along with many others, shape our trading decisions, often leading us off the course of our well-laid plans. But don't despair. Recognizing these biases is the first step towards managing them. So, the next time you're faced with a trading decision, pause. Step back from the heat of the moment. Ask yourself, am I making this decision based on my strategy, or am I being swayed by my biases? This self-awareness can be the difference between a rash decision and a calculated one. Remember, successful trading is not just about making the right decisions, but also about managing your emotions and biases. Have you ever made a trade out of fear or greed, only to regret it later? Imagine this scenario. You're in the thick of the trading jungle. Your heart beats faster as you see the price of your chosen cryptocurrency skyrocketing. The green candlesticks on the chart look like a stairway to heaven, and you're filled with a sense of euphoria. This is it, isn't it? The big break you've been waiting for. Driven by your greed, you buy in. Or perhaps it's the other way around. The market is crashing. Red candlesticks are cascading down the screen, and your heart sinks with them. Panic sets in. You sell everything, driven by a crippling fear of losing it all. Later, when the storm has passed, you look back and realize those hasty decisions were made under the influence of raw, uncontrolled emotions. These situations, ladies and gentlemen, are classic examples of the devastating effects of fear and greed in the world of trading. They compel us to abandon our well-thought-out strategies, to act on impulse, and to risk more than we can afford to lose. So how do we combat these powerful emotions? The answer lies in emotional control. It's about acknowledging the presence of these emotions, but not allowing them to take the driver's seat. When you feel the rush of greed, take a step back. Remind yourself of the risks involved, the volatility of the market. Remember, the market owes you nothing. It's not about getting rich quick, but about making calculated decisions that align with your long-term goals. When fear grips you, breathe. Reevaluate your position. Remember, the market is cyclical. Prices rise and fall, but panic selling often leads to regret. It's about staying calm, sticking to your plan, and not letting fear cloud your judgment. In the end, it's not just about making profitable trades. It's about becoming a disciplined trader, a trader who can navigate the stormy seas of the market with a steady hand and a calm mind. Controlling your emotions is key to maintaining discipline and consistency in your trading. Did you know that price action charts are a reflection of traders' collective emotions? Now that might seem a bit abstract, but let's break it down. When we talk about price action charts, we're essentially looking at a visual representation of the decisions made by thousands, if not millions, of traders worldwide. And what drives these decisions? You've got it. Emotions. Fear, greed, hope, and regret. These are the primary emotions that move markets. Consider a bullish market, for instance, where prices are on the rise. This upward trend is typically driven by a collective sense of optimism or greed. Traders are hopeful, they see potential for profit, and so they buy. This buying pressure drives the price up, creating the upward trend we see on the chart. On the flip side, a bearish market, where prices are falling, is often a reflection of fear. Maybe there's bad news on the horizon, or perhaps traders are simply worried that the good times can't last. This fear prompts selling, which in turn drives prices down, creating the downward trend on the chart. Now here's where it gets interesting. These emotional cycles create patterns in the charts, patterns that savvy traders can spot and use to predict future price movements. For example, a sudden spike in price might indicate a surge of greed in the market, which could be followed by a correction as traders start to fear they've overreached. But what does all this mean for you as a trader? Well, if you can learn to read these emotional undercurrents in the price action charts, you can predict market trends and make informed trading decisions. You'll know when to hold them, when to fold them, when to walk away, and when to run. So remember, price action charts aren't just lines and numbers. They're a window into the collective psyche of the market. By understanding the psychology behind price action charts, you can gain an edge in your trading. How do you decide how much to risk on each trade? Let's talk about risk management, a key pillar in the world of trading. It's not all about charts and patterns. It's also about managing the emotions that come with the potential for gain and the fear of loss. Risk management is like a safety net. It's there to catch you when a trade doesn't go as expected. But what influences how wide we cast that net? Mostly, it's our psychology, our fear, our greed, our past experiences, and our future aspirations. Imagine a trader named Alex. Alex is new to the world of trading and has been making small, consistent profits. One day, Alex spots a trade opportunity that appears too good to pass up. The potential for profit is enormous. So Alex, driven by greed, decides to risk a large portion of his portfolio on this single trade. But what happens when the trade doesn't go as expected? Alex's portfolio takes a massive hit. His confidence is shattered, and he's left questioning his decision-making abilities. This is a classic case of poor risk management influenced by our psychological tendencies. In contrast, consider another trader named Taylor. Taylor has a different approach. He understands that not every trade will be profitable, and it's important to limit potential losses. So Taylor, driven by a healthy fear and respect for the market, only risks a small percentage of his portfolio on any single trade. When a trade doesn't go as planned, Taylor's portfolio sees a minor decrease, but nothing damaging. He remains confident in his strategy and continues to make consistent profits. This is a perfect example of good risk management, where fear and greed are kept in check. Risk management is a game of balance. It's about finding the sweet spot between fear and greed, between potential profit and potential loss. Remember, every trade is a risk, but it's how you manage that risk that determines your success in the long run. Good risk management is not just about numbers, but also about managing your fear and greed. So, how can you use trading psychology to improve your trading? The answer lies in understanding your emotions, biases, and decision-making processes. Remember, in the world of trading, your biggest competitor is often yourself. The charts and price action you see are not just numbers, but a reflection of human emotions and psychology. When you learn to control your emotions, make informed decisions, and manage risks effectively, you become a better trader. It's not an overnight process, but a journey of self-discovery and continuous improvement. Use the practical examples and case studies we discussed as a guide. They will help you understand how human psychology influences the market and how you can use that knowledge to your advantage. Remember, trading is not just about charts and numbers, but also about understanding yourself. Don't forget to like, subscribe, and sign up for our newsletter for more trading insights and tips. Happy trading.